Hi, in this video I'm going to talk about one of the earliest business or personal finance book that I've read. In fact, I believe it was in the year 2000 when I first read this book. It has some impact in how I see things, and it is one of the reasons which I still persist in the line that I'm doing. I mean, in the sense that, exploring the world of business. I'm still a huge novice. Uh, there are many facets, but it's nice that this book helped nudge the way. And since I first read this book back in 2000, I've been reading the other books in the series. I'm sure you would know it's the best-selling book, Rich Dad Poor Dad by Robert Kiyosaki. In fact, this particular book, I would say, forms the foundation of how I see personal finance and business, even though I'm still trying to completely apply the mindset, change the way I see things. It's a journey, and I'm grateful that I am able to read this book back then. There are many concepts, of course, that he shares in this book. Let's start in this video covering the ESBI matrix, the 2x2 ESBI. So basically, ESBI, E stands for the employee, S stands for the self-employed, B businesses, I investors. Now, I believe I jump ahead in that. Yeah, I think I jumped ahead. Oh dear, I think that's the cash flow quadrant. Sorry, that's the second book. I'm mixing up with the first book. Sorry. Anyway, coming back, in Rich Dad Poor Dad, the earliest basic principle that he shared is the definition of assets, liabilities, expenses, and income. Right. So the quadrant that he shared, sorry, not the quadrant, the chart that he shares, that he introduces in this particular book is, if you can imagine, the income statement chart rather. So above the income, the expense, you have the assets and the liability. Basically how he defines it is, an asset, unlike conventional accounting, asset are things that generates income, that puts money into your pocket. Liabilities are whatever that takes money out of your pocket. Basically, the more liabilities you have, the higher your expenses. The more assets you have, the bigger your income, right? And of course, the difference between your income and expense leads towards financial success or failure, right? Yes, again, if you were to speak to any accountant, they would certainly disagree with this, because an asset in terms of accountancy would basically mean anything that creates value to an entity or to a person. So an asset, for example, could be a house. But where Kiyosaki reinterprets it, the house is only an asset if and only if it generates income for you. So if you're a property owner, you have 4 houses, or 5 in this case. You're staying in one, right? You're staying in one house, you're renting out the other 4. Because your residence, you're paying for the maintenance, the upkeep, it's not generating income. This house is seen as a liability under the interpretation of the Rich Dad Poor Dad principle, right? Because it's taking money out of your pocket. Compare that to the other 4 properties, 4 houses that you own. Because you rent it out, it's generating an income. So when it can generate an income, a positive flow, that house moves from a liability to an asset. In this case, in the income statement postulated by Robert Kiyosaki in Rich Dad Poor Dad and his other Rich Dad series. Right? Now, what happens if you own one of these properties and it's generating a loss? So that particular property becomes a liability. Now, again, if we look at contemporary or conventional accounting definition, Assets are anything: inventory, your car, your vehicles, your stock, your houses. Well, I don't think stock applies. Sorry, your house, because it adds value to your income statement, to your, at the end of the day, the income statement and the balance sheet. It is seen as an asset, so it contributes to your so-called net worth. Whereas liabilities would be the loans that you owe or are owed to you, okay, among many other definitions. So liabilities are things that reduce your value or your net worth. So asset plus liability equals to net worth, roughly. That is the conventional accounting perspective. But again, it's starkly different from Rich Dad Poor Dad. I know I'm repeating myself here. So let's say it's not a house, let's say it's a business. So you have an enterprise. When your enterprise or your business or your partnership is making money for you, it's giving you, it's generating income for you, not only your monthly income, but probably a profit sharing at the end of every financial year. When it is positive for you, it is an asset. So business is not defined by just being a Sendirian Berhad or a private limited company, share in a blue chip stock. It also includes, if you're going through network marketing, that network marketing activity, that business, if you will, could be seen as a form of asset because it's generating income. So if you're working as an agent, say a unit trust consultant or the TS area, you're an insurance agent and it's making money, that practice of yours can be seen as an asset. So it is your asset because it's giving you income. But if the activity or the body of activity is taking money from your pocket, it's a liability. As I mentioned earlier on, where it stands, whether it's a liability or an asset, it is dynamic. It can be an asset today, but a liability tomorrow, vice versa. So that is where the principles of income, expense, asset, liability in the Rich Dad series differ from conventional contemporary accounting. It is an interesting way to see things. It makes you, even if you don't appreciate fully, it helps being aware and helps you navigate through multiple decisions that you have to make, especially financial decisions. And of course there are doodads. Doodads are neither assets nor liabilities, things you buy for the fun of it. It could be a book. A book can be an asset or a liability depending, Other topics which we shared are good debt and bad debt. Things like changing the mindset. It is not money that is the root of evil, rather it is the love and lack of money which is the root of all evil. There's a lot of things that he covers in the book. Now for this 20 years anniversary edition, I have not read it yet. I'm speaking from memory. 19 years ago. I'm still impressed I can remember that. But eventually the idea caught on, and I see where these principles resonate in books written by Tim Ferriss, Chris Guillebeau, where their topics include like the 4-Hour Work Week, the $100 Startup, and many other business books. In fact, this book has been used, the principles in the book has been used to market many initiatives, many businesses, many investment opportunities out there, legit or otherwise. But again, it's a good mindset it's a good book to change, to see differently, to appreciate things differently from how we normally would. Yes, it is controversial in its own right, but how I see it is, as the Malay saying goes, buang yang keruh, ambil yang jernih. Find which is good and apply it, and discard which you can't apply or which is irrelevant. It is not exactly the Bible. It is not engraved in stone. It is a wonderful book for personal finance to get the right mindset to enter business, especially when you're beaten down financially and you'd like that extension of hope. Right. So thank you very much for watching this video. Please share or give it a thumbs up. I appreciate your feedback. Which part of the book that you like, which part of the review that you think is a hit or a miss. And since this is quite a new activity for me, I appreciate your feedback. Thank you very much and have a great day ahead. Bye.